Hi, welcome to Wise Beyond Bitcoin, your home for the crypto neo news, education, and opportunities. My name is Ryan.
My name is Lucas. And speaking of news, education, opportunities, we have it all right here. We've got playlists for you. So if you like staying abreast of the latest that's going on in blockchain and crypto, we have playlists that walk you through tutorials. If you're brand new, how to download a wallet, send, receive, staking. If you've heard about NFTs, staking, proof of stake, we've got videos to educate you and walk you through that process, help you learn how to make those decisions. What is an NFT? Secret network, privacy NFTs, privacy in the blockchain. We're all over innovation in crypto and bringing that to you so that you can do your own research to be your own bank and find those opportunities, because we're not financial advice, commercial advice, legal advice. We're just sharing our research. It's entertainment, it's educational information. Now, we don't just talk about blockchain and crypto. We love to look at blockchain and crypto as an emerging market, a new technology, finding its way in the economy and the markets at large, and how they react together and interact together. So with that being said, Ryan, what have we found lately?
Well, we have another macro update for you. It's where we take a look at what's going on with monetary policy, markets, traditional financial markets, and expectations of the near future. And we put all this, all this analysis together and kind of draw some conclusions with what to expect with crypto markets. Because like you say, it's all connected and these things do matter.
And it's fun, really, it's fun to be a part of this narrative and process. Drop a comment below with any insights you may have. This is an interactive channel, and you can support, subscribe, notification bell, all that good stuff. But really, it's exciting because a year ago, 2 years ago, 3 years ago, there was not much talk of Bitcoin or blockchain or crypto in traditional markets at all. And now we are hearing a lot more talk of blockchain, crypto, Bitcoin, regulation, DeFi, and its role in the economy coming up. So these are good times, great times to take your time to learn about what's happening. That being said, there is a lot of correlation and connection between the two. That we have another video. We're going to talk about decoupling in the markets. As of now, I don't see too much decoupling happening.
No, it doesn't seem to be. The crypto markets seem to be moving pretty much in tandem with the mainstream traditional markets. There does seem to be a little bit of a little bit of stickiness, I guess you would say, but that's, I think, largely because the point you made is that there's so much money moving out of crypto that the normal analysis has to take that into consideration. And days where we see mainstream financial markets rallying, in the past we would see crypto rally along with it, and I feel like that's not as happening to the same extent. And it's because some of the enthusiasm, I feel like, it's been taken out of the market, and part of it is driven by comments like what we're about to look at here from the Federal Reserve President Mary Daly. Speaking of, right?
Speaking of correlation, let's look at what the Fed's talking about and what we can expect in the future.
So we've definitely known for some time now that the Fed has moved from an easing footing to a tightening footing, and that involves raising interest rates, among other things. And we've expected for a while now that we would see a series of rate hikes, right? We've made videos about this going probably back 6 months or more. So we're just going to kind of update you on where we're at. And the call now is for at least 2 more, if not more, but at least 2 50 basis point hikes. And so that would bring us, if you do 2 of them, that would be a whole interest rate point, a whole percentage point, and that would have been raised. And the goal is to get short-term interest rates, the Fed funds rate, to 2.5%. That's the goal. And that is seen by many as the neutral rate, the rate that neither constricts borrowing or stimulates it. Neither constricts demand nor stimulates it. And this concept is, it's been debated. Does this number even exist? Is there such thing as a neutral rate of interest? Or another way of saying this is the natural rate of interest, the rate of interest that would that would express itself on the market if there was no policy intervention, right? And this is a concept in economics that goes back to this Swedish economist named Knut Wicksell, and he popularized this idea. The Austrian economists borrowed this, and it found its way in the business cycle theory of Hayek and Mises, and it exists today in the Fed's own analysis as a goal, right? In order to find that footing that doesn't overstimulate but doesn't also constrict credit.
And Milton Friedman also wrote about this.
Yeah, I think he talked about it as well. Yeah,
the right interest rate that would be perfect for GDP for growth, but not too much to inhibit and cause.
It's kind of like the Goldilocks policy, right? Not too, my porridge is too hot and mine's too cold. You know, it's like, well, can we find a happy medium? You know. So, but of course,
in reality, you could imagine that growth doesn't happen linearly, and you would find that some years or sometimes the market would grow at X% and other percent. So like you said, does there exist some magical number that you could just say flat line, this is the rate of growth?
Right.
Does that number exist?
Or is it purely contextual, changing with the moment, right?
Yep.
That's a good question. But what we can say is that the number that we're targeting is significantly higher than where we're at today, and that we can plan on a few more rate hikes, you know, before we get there. Now, this is one pathway to tightening that we wanted to mention, and it's definitely something that people in the stock market, you know, are not super eager to hear. But the other is the one that's really an untested, unknown, kind of an unknown quantity of how is this going to impact things. And it's a new policy tool called quantitative tightening. And this is the exact opposite of quantitative easing, QE, which you might have heard of if you've been following financial press in the last decade. But the idea with QE is that the Fed would purchase assets and then expand its balance sheet. And by doing this, more money would be flowing in the credit markets, and it would be stimulative. And the other, so as you do that, there's always a plan to unwind, right? You're stimulating, well, you got to have a plan to pull that stimulus back, right? Especially if you get to a point where it's you've overshot the goal, right? You've maybe added too much. So that's what quantitative tightening is. It's a way of the Fed it's a way they reduce their balance sheet and sell off assets. And in the way this is going to happen is that when bonds that the Fed holds, when they mature, instead of repurchasing another bond, right, a new bond with a different, longer maturity, or a bond that they would be able to hold for another few years, they just let the bond mature and then they don't replace it on their balance sheet. And that's a way of essentially reducing the amount of money circulating in the economy, and their balance sheet would also decrease by that amount. And right now we're talking about a $47 billion reduction in the balance sheet every month, and then after Labor Day it's going to go to 95 billion. And this is sort of, in the article talks about it, it's like they're not really sure, what will be needed. There's a lot of uncertainty here on how the markets are going to respond, and so they're going to need to be very careful with this. And it's unknown what could happen. How much impact is this going to have? Is it going to create a recessionary sort of environment? And one of the kind of why, what you might ask, well, what's the big deal here? And the big deal here is that it's about liquidity. That's really what it's going on here. So markets, they need liquidity, just like in DeFi. When liquidity is pulled out of a protocol, you see that protocol seize up, and typically people run for the exits, and the assets that are there get sold off, and it's hard to find buyers at the going rate, so the prices fall. And you can see liquidity problems being the death knell of a market. And that's the issue here, is that when the Fed lets their balance sheet shrink, that the money that goes to the Fed, they don't put back in the market. That's money destruction. And this is these assets, when the Fed buys them, there's a corresponding payment that's out into the economy, and that payment is then the liquidity that's circulating in short-term credit markets. So when banks make loans to each other, or when banks make loans to small businesses for short amounts of time for them to handle their payroll, they do it out of this fund that's fueled by the Fed purchasing these assets. And there's even overnight markets where they do repo transactions where they'll purchase something for a certain amount of time with the plan to resell it, and it's like a loan essentially overnight. And so these sorts of actions are kind of what sustain liquidity in markets. And so the question is well, what happens when the Fed steps back? You know, what effect will that have? And it's very much an unknown. And we'll see how that plays out. But just having the guidance is it's definitely a tailwind, right? Or a headwind rather, not a tailwind, a headwind that markets are going to have to get over. It's a barrier to price appreciation in the short term, for sure.
And it's a new, I don't want to say externality, but it's a new, you know, we've been following this for some time now. Our interest in markets and economics before blockchain and crypto, one reason we continue to share about economics and what's happening with the Fed is because it's kind of our passion and what we get excited about. And for those who do like monetary mechanics and monetary history and understanding more about how money works, then you would know that the Federal Reserve has been employing a whole bunch of new tools out of its toolbox. And we're really living in some revolutionary times, not just the decision to no longer to support these to drop its balance sheet and to no longer support these repurchases. But you know, they've been
the whole thing itself, the whole QE program has been an experiment, right?
Absolutely. And going into the market and directly supporting certain industries and propping up areas of the economy in the private market, that is something that never before was thought of for the neutral Fed to do. So we're living in some wild times for the mainstream modern monetary economic system. Have nothing to do with Bitcoin, has nothing to do with blockchain, has nothing to do with crypto. If you just look at the problems being faced with the inflation and with the interest rates, absolutely.
And that's a whole different video.
And we'll make it. But we've also made a video in the past on how good news became bad news in this upside down world of what's going on.
That's right.
Today, and that's a little segue into.
So let's talk about that. So today you're seeing markets kind of rally, right? There's some mixed, and it's counterintuitive. We just talked about the Fed and monetary policy and how that is definitely a net negative, right, for risk on trading and for future stock price growth in the near term, right? But markets aren't responding to that as much as they're focusing on what's going on with a recent employment data that came out. And what's going on there, and it's counterintuitive, but that's kind of why we're talking about it. But essentially what happened is that the recent employment report showed that private payrolls rose by only 128,000 jobs in May. And the estimate was that it was going to be closer to 300,000 jobs. So what that's suggesting is that their demand for labor is cooling. It's starting to slow down a little bit. And so this is not good, right? If it's not good news, right? Generally, you want the economy to be, a healthy economy is one where the demand for labor is growing, right? So the job growth is happening, right? And that's good for incomes, and people then can turn around and spend that money, and that, you get this virtuous cycle. And the opposite's true. When you see the demand for labor falling, that means that job growth is slowing and that incomes might slow with it. And then that demand story works in the reverse. Well, so the question is why would the market be rallying on bad news? And the reason is, and it's really, once you hear the reasoning, it's obvious. But essentially the idea here is that bad news is good news because a cooling economy means that the Fed can maybe calm down on their rate hikes. And it's because it shows that inflation, the pressures that are driving inflation are reducing. right? So part of what drives inflation is the demand for labor. And if the demand for labor is slowing down, then the inflation of wages that we've seen would slow down, right? So it's a signal that the inflation problem might be working itself out, and or at least it's getting better, and that the need for these more sustained tightening on the part of the Fed might, the calculus on their part might change. They might become a little more careful about how fast and hard they hike rates. And so that's good news for people in the market. So it's sort of a bad news is good news thing. And it doesn't always seem intuitive until you really start thinking about it. And it really just goes back to markets are driven more by what they expect the Fed to do than they are almost anything else.
Mhm. Well,
That's the main takeaway. Now, that's a good segue into this article about the other pathways to fighting inflation, because the Fed's monetary policy tools are kind of like chainsaws in the sense that they're not incredibly precise, right? It's the Fed does a policy move and it's economy wide, right? It affects lenders and borrowers on all walks of life. Whereas and they can often get these numbers, they can get these things wrong, right? They can stimulate too much or overcorrect, over tighten, right? The Great Depression is a sort of a perfect example of the Fed definitely overstimulating in one period, and then at the other, once the crisis started to unfold, instead of responding by injecting money, they did the opposite, and they kept things way too tight. And so there was a shortage of money, that was a shortage of credit and money, and that made the Great Depression longer than it otherwise would have been. And there's other times where they got this wrong as well. So the idea is that the Fed's policy tool of tinkering with interest rates and tinkering with their balance sheet, it's very difficult to get that 100% right. It's a blunt object, and what's really called for is more precision. So you look for other tools. What are the other ways we can deal with this problem? And according to these economists at this policy institute, Peterson Institute, they believe, and they're on firm ground, according to economic theory, this is not a stretch. They believe that trade liberalization would be a even more effective way than rate hikes with dealing with inflation. And the idea here is that there's been a lot of tariffs that have been put on international trade in the last 5, 6, 7 years. And that what this does is raises the cost of goods to consumers. And simple, it's a tax on consumption, right? And so the idea is that by reducing these tariffs, we could get a immediate cost savings at the point of sale, right? That the supply of goods would grow, the price would fall, and it would it'd be a way of mitigating the inflation problem without using the Fed, without putting the whole burden on the central bank to solve the problem, right? And we'll leave this in the comments, so we'll leave this in the description, so you'll have a link to this. But it's something I'm immediately attracted to, because it'd be a way to quickly get some relief without without trying to go through an indirect pathway like with the interest rates.
yes, I think this would be the best outcome, the best approach. And I think it also would stimulate new economic growth, new jobs. I feel by, anytime you have a lowering of costs, because lowering of consumption is also lowering of cost inputs at the end of the day for other people who are trying to get projects up off the ground. So although maybe those industries that were protected by the tariffs may not benefit, you would see that opportunity being distributed to many other markets or entrepreneurs with lower cost inputs, and seeing other jobs emerge. So yeah, this could ripple out and have a lot of benefits, but not the least of which is immediately lowering the cost of goods for people who are trying to get by and survive when the job market is difficult and prices and inflation are going up everywhere. So to be able to do something that will immediately take a burden off of the people make it easier. I think this is ultimately the best way to try to solve the inflation issues. And like you said, taking a chainsaw where a scalpel is needed, this benefits people directly in many ways that tinkering with interest rates and the Fed balance sheet doesn't even go directly to help many of the people.
Right. No, yeah, it takes a long time. There's policy lags. It takes forever for that stuff to work its way to the common person, right? Sticky prices, just the access to credit is not, even across the board. There's a lot of things that happen that redistribute wealth when you cut interest rates and when you raise them, because it happens in both directions.
Yep.
One thing I'd like to point out is that they estimate this would be close to reducing CPI inflation by up to 2 percentage points. That's a huge, that's worth highlighting. That's a lot right there, And also the other thing I'd mention is that when you do trade liberalization, there's more money that we're sending overseas because we're buying more imports, right? So more dollars go overseas, and those dollars then are available to buy US exports. So trade, not only do we import more, but we export more. And that would boost the incomes of a lot of workers and businesses in the United States, which would then enable them to be able to afford, and be able to offset some of the inflation that they're dealing with, right, through higher incomes. So that's another thing. And some people might say, our inflation problem is purely based on COVID era responses, right, to the shutdown, right? There was checks that went out and the Fed printed a bunch of money, but in reality, there was measurable changes in inflation that happened when these tariffs were put on. There's many articles, I don't have them at my fingertips, but you can find them, but there's article after article showing that years before COVID, years before the Fed did anything, there was a problem with inflation that was directly tied to these tariffs, that immediately the prices of all these goods and services went up. And we even had to bail out some soybean farmers and other exporters in the agricultural industry to the tune of billions of dollars prior to COVID. And it was all because of trade retaliation coming from the tariffs. So it's clear that there's a direct relationship between tariffs and inflation. And yeah, it seems to be an obvious one. The Biden administration shouldn't have a problem making these changes, especially because they were largely put in place by the previous administration, and there's not a lot of love lost between those two, So why would Biden be so resistant to undoing some of the things that Trump did? It's an open question, but the economics support it. I would say that.
It will be interesting to see how this information ripples out and what decisions are made in the future, because they are all the health of the traditional market. And we like to talk about the growth and the future of blockchain and crypto and these other opportunities. Well, it's all connected. So obviously a healthier economy for people to have pressure off of the high gas prices, high energy prices, high food prices, that's going to impact the blockchain crypto market as well, right? During the bull market days, people weren't worried about the cost of energy. People weren't worried about a lot of the issues that are happening now. So you could throw money at the new project, throw money at this, and try these high risk. And now people are looking at, well, how am I going to pay the mortgage? How am I going to pay for groceries? Right. Look at the cost of energy. And so you're seeing a lot of money come out of these, I don't want to say not luxury goods, but
well, they're definitely not necessities, right? You have to eat, you have to pay for your food, your water, your housing. You don't have to have a stake on DeFi.
And right? They don't have the capital constraints in that you find in traditional markets.
Right.
So
it can flow out.
In traditional markets, if somebody wants to liquidate their 401k, they can't do so without a bunch of hoops to go through and penalties. Whereas in blockchain and crypto, if people start, getting a little fearful and don't like what they see, then they can turn around immediately.
So that's a good point. That's a
Right.
good point. Well, let's wrap it up with a little comment from JP Morgan. We don't need to get too in depth into this, but it's just interesting to see how the narrative shifts, right? And that's one thing we've talked about, is how Bitcoin started off to be talked about as, you know, you were dumb if you had it. And I think JP Morgan said they'd fire somebody if they knew that they were investing in it, you know, and work for them. And now, you know, fast forward a couple of years and you've got JP Morgan sharing, well, they've made it accessible to their investors, to their clients. There's they're tracking it. They're talking about it's, you know, how important it is, and how it's, you know, how it's got a future, and their upside has significant upside potential. And now they're even sharing charts like this, which compare volatility in Bitcoin to gold, and in various maturities, I guess you would say, or time in the various timelines, 3-month and 6-month volatility for Bitcoin versus gold, and showing how the convergence that's happening. And there's even a talk about how how Bitcoin could eventually reach gold's market cap, and what they expect going forward. So definitely a shift that you're seeing in the narrative, and it's treating Bitcoin as another asset class, along with real estate, gold, bonds, that are sort of a hedge, right, against uncertainty. And but it goes without saying that the volatility it's even though it's shrinking and it's approaching gold, there's still been a lot of loss in Bitcoin over the year, right? Where Bitcoin's down, I believe it even goes into it in the article, about 38%, whereas gold is up by a small percentage,
3% or something.
3%, yeah, here. So it's not to say that the price is following, because it's clearly not, but the volatility, the amount of volatility in Bitcoin is starting to come down. And so that's, you know, that's showing the asset class is maturing.
And it's interesting that it's maturing, and it's kind of that correlation, the volatility is heavily correlated to gold, whereas that's what Bitcoin has been most often compared to in the world of digital assets. It's been called a digital gold, a digital store of value. And when people look for a store of value or gold, it's to protect them from the volatility in the outside market as a hedge, you know, as a store of value. So seeing that the volatility of Bitcoin, the volatility of gold are closely tracking each other is funny, and is telling of the possible future continued, you know, use case. And
yeah,
we've heard, I mean, it's not a surprise. You listen to all the big names from institutional investment and finance, and right, Michael Saylor, and around Bitcoin and crypto, it's spoken of as a digital gold. It's spoken of as a hedge.
Yeah.
So we're really just watching it fulfill really what many people are hoping and manifesting it. They're making it happen. More people pour into it, wanting to turn it into a hedge, and you will see it happen.
That's right. Well, I think we covered it. That's your macro update. Anything else?
I think that's it. We've got some more awesome, fun economic news articles and content to come your way. So if you'd like to support the channel, you know what to do. We've got those whale addresses below. Throw a little krill this way. We also have a subscribe button and notification bell, so you can be alerted onto the next blockchain innovation. We'll be dropping some more airdrops and crypto opportunities and more macro updates and economic vids. Until the next time, have a beautiful day. Namaste, y'all.